Welcome back to Investing Wizards. I have the honor of having Bill Brewster, who is an investor and host of an amazing podcast called The Business Brew. Welcome, Bill.
Thank you. Thank you for having me. We got an amazing sponsor on the Business Brew.
You do have an amazing sponsor in The Business Brew.
That's right. It's this company Koyfin. You ever heard of it?
I've heard of it. Rings a bell.
Yeah.
It's so I guess in full disclosure, we started sponsoring The Business Brew this season for your second season, and it's been awesome. It's great to be associated with your brand. I started listening to your stuff more, and I just I love your format. I love how it goes against everything today that's like TikTok, 30 seconds. You have these in-depth conversations that go into these really deep into a lot of different directions. So why don't we start off with you telling us what you do and maybe a little bit about the Business Brew.
All right. So I got into investing because I had a family situation. It's an inheritance of sorts, or actually is an inheritance, that I figured I need to understand how to run my own capital in a way that I can stick to if times get bad. So even if I were going to allocate to a manager, I would need to understand why I picked that manager. And I don't fully trust ETFs, especially where I think some of the market cap weighted valuations are today. And regardless of whether or not that's a sound conclusion, I think that not trusting what you're doing is a sure way to kneecap yourself when things go bad, right? So I sort of set out to find a strategy that I could stick with when times got bad, and 2020 sort of provided the testing ground for whether or not I was ready to stick with the strategy. And I would say that for me, sort of my true north and who I've, sort of patterned my, I guess, overarching philosophy from is Buffett. But I am not nearly as theoretically perfect, as emotionally perfect, or as smart as he is. So I have some degenerative diseases that occasionally come into my investing process, some of which I look at like fund flows a little bit, probably too much. And I do have a little bit more trader in me than I would like to have, but I try to temper those feelings. I tend to do better emotionally when stocks are cheap, but the cheap ones tend not to work. So it's been interesting. I in 2020 was smart enough or lucky enough, or a combination of both, to get into an information flow that sort of tipped me off to what COVID could be a little bit earlier than I think most people appreciated. And I had some airline and financial exposure, and I rotated out of that pretty much by March 12th. I was out. I was a pretty strong believer that I didn't want to adjust my beta exposure. So I said to myself, I should pick the best businesses that I can think of because I want to stay in the market. And I rotated out of airlines and banks into like Microsoft and Visa, for instance. Bought a fair amount of TransDigm in March, thanks to some smarter people in my network, putting my radar on that security and business. And I was comfortable given what I had known from aviation generally from following the airlines. And, that stuff worked out. And then I found a special situation in Curate towards the end of the year, which I ended up rotating a lot of my Microsoft and Visa money into. So it was a tax inefficient year, but a good year. And I think for a lot of the right reasons, I was right. And I'm still trying to decipher who I should be going forward. But I'd run no outside capital, and I have a lot of warts, so I wear them. And the Business Brew is sort of my way of having conversations with people a lot smarter than me, and trying to figure out. I'd like to think I add something to them too, but really how what they think can be additive to my process. And then my hope is, if I am not smart enough to add something to them, the collective guest list is. So I'm proud of the guest list that I've curated. I think it's a very diverse group of investors, and it's been really fun to get them to open up and talk a little bit.
Cool. What's so just real quick, what's been the most popular podcast that you've had, just in case someone wants to go and listen to one to start out?
Oh, I mean, I think if you were going to start one to just listen to, I mean, I'm going to say Jim O'Shaughnessy because it was the first that Koyfin sponsored. But if you wanted to go with another one, I'd say Arnold Vandenberg. I mean, he's such an incredible human, and just listening to his philosophy. I mean, this man survived the Holocaust. His parents survived Auschwitz. They were separated from him when he was, I believe, 3 years old, and he's gotten himself to a point in life where he forgave the Germans for what they've done to his family. And I think that they ended up taking like 30 plus members of his family. And just to be able to interact with a guy like that is, I mean, a dream come true for me, because he's just a phenomenal, phenomenal human. And I was really proud to be able to deliver that. I think that's like an episode that's actually meaningful. The investment stuff, honestly, I like them all, man. I there's some endowment bias in that, but I'm really proud of the catalog.
Cool. Awesome. So just in terms of your background and your style, one of the things that kind of like caught my eye is that you're you went to law school?
Yeah, I have a JD and a
Yep,
CFA.
you have a JD and a CFA. And so our mutual friend, Elliot, who introduced us, has a similar background. And it has that, like, what impact has that had on your investment style to kind of have that training? I mean, it shows up in kind of, or at least for me, like when I listen to you speak and think, you have a very kind of like clear structure to kind of the way you break down things, the way you think about things. Is that kind of your personality, or does that have to do with law school, and how does that impact your investment style?
I appreciate the compliment. First and foremost, Elliot's way smarter than I am. Part of my genius is I'm smart enough to be friendly with people like him. I think that what law school has helped me do is I got into the habit of law school of seeing things from both sides, and I don't hold many opinions super strongly anymore, right? So there are some things that I will not budge on, but as I'm getting older, I'm finding fewer and fewer of those, because I think I'm reasonably good at forcing myself to argue the other side, even on like highly emotional issues. For instance, like my cousin-in-law committed suicide. He was the Robin Hood trader, and I had a discussion with Tom Sosnoff, who founded Thinkorswim and now Tasty Trade. And Tom's position is that the introduction to options trading is actually a good thing, because it teaches people how to take risk and own risk. And at first, I mean, in the conversation, I kind of stumbled through the conversation, but when we got off the mic, I thought a lot about it, and I thought about my own progression. And without finding Thinkorswim and without starting trading options, I wouldn't be doing what I'm doing now. And there is some merit to that. Now, I really strongly believe the one thing I won't budge on is that customer service must be provided to people that are trading options. But I'm a little less dogmatic on how bad for society options trading is than maybe I even was a year ago. So I try to apply that kind of thinking to investing, and I really do try to seek out different viewpoints and try to understand what other people are saying. I think that was probably more trained than not. When I was younger, I was kind of convinced I was right of the world, and then all the questions changed on me.
Yeah, it's I feel like in throughout my career in investing, I've definitely noticed that kind of like younger, more insecure analysts, PMs are the ones that are pounding the table to try and convince other people that they're right, and to be the loudest one in the room, and the ones who are constantly questioning their own beliefs and really seeking out something to dissuade them are the people who make kind of are the most senior, seasoned, and the ones that end up making the most money over time, because the world changes so quickly, and you just you can't be right about everything, just given the pace of change. Have you ever met Buffett? Like have you ever more than just
No,
like
our shoulders almost brushed one day in a bar in the Marriott, across from wherever he holds his, the convention center. But no, I've never met him.
got it. He was drinking his Coke and eating his candy, and you kind of
No, he walked by, and I almost tried to nudge him a little just to be like, I touched Buffett, but then I didn't want to hurt him, so I didn't. No, he's got better things to do than meet me, but it'd be pretty cool. I've gone back and forth on whether or not you want to meet your heroes, but I wouldn't say no to an invite.
Yeah. Okay. And so, can you just walk through, like, we're going to talk through some investment ideas in a little bit, but in terms of like how you go about making an investment, are there anything, obviously, maybe you do some things that are common to what other people do, including, looking at the management and reading kind of the transcripts and all that other stuff. Is there anything that's particular to your process that you focus on more than other investors?
I don't know that I focus on anything more than other investors. I think, if I have a weakness, it's that I pull the trigger a little bit early. And if I have a strength, I think it's that I'm willing to revisit something often. And maybe those two things are, coupled, and maybe the strength is actually a byproduct of the weakness. I don't know. I've heard a theory that most people's strengths are actually in some way tied to their weakness. And I kind of like that. If nothing else, it helps me justify my actions to myself. But, like I have, if anything, I have a high degree of respect for free cash flow over everything else. And I think that, if I have one overarching thought of where the market is right now, and kind of what is maybe driving my behavior, is I want cash flow on the front end that is reasonable given the asset that I'm looking at. So I don't think all assets should trade at the same free cash flow multiple. I think that's insane. But I do think that, I look at historical free cash flow multiples that the assets traded at. I look at where the peer group's trading. I care about that stuff a fair amount. And I guess that, maybe what I would say my Achilles heel on average would be is maybe the willingness to go down quality because the free cash flow is higher. Said differently, maybe I like a little bit too many value traps. But that would be where I think I have more of a focus, and where I have done the best is good companies undergoing temporary problems that I've swung hard at. Whether it's, TransDigm or Charter in 2018. That's Curate they had a capital allocation decision that changed. So that's sort of different. But I like habit. I like free cash flow, and I'm not that afraid of leverage, but those can be famous last words.
And do you use technical analysis at all?
I don't. I used to be a chartist, and I don't disparage technical analysis nearly as much as some people do. I think that maybe it makes more sense from an entry perspective than an exit perspective. But I kind of believe in free cash flow multiples too much to get into technicals. That said, waiting for momentum to change would probably add a little bit of improvement to my results.
Cool. Okay. I guess in terms of value, just waiting for the market to catch on and to see that shift in sentiment for the stock to start working would.
Yeah. That's right. Yes, when I get into trouble is something like, Wells Fargo, I got into trouble on because I didn't fully understand the cultural problems there and what was really going on. And had I waited for some sort of moving average crossover, I would have avoided that particular issue. I'm currently living it in Altice. So I do think that there are some scenarios where momentum would probably add a fair amount to what I'm looking at.
Cool. So I think with that, why don't we get into some investment ideas? And I'm just going to pull up Koyfin just so we have a backdrop to discuss this, to have this conversation. Let me share.
I think I gave you like three stocks with negative momentum that are kind of bombed out right now. So
the opposite of what I just said. Yes.
That's right. So there's a peek into my brain. I do want to caveat what we're about to talk about by saying that any of my investment ideas should be heavily discounted because I spend most of my time on the podcast at this point. But nevertheless, we shall discuss.
Well, with that caveat, so what's the first stock you want to talk about?
Well, I mean, we can. Let's do MSOS, the ETF.
Okay, so MSOS. Tell us about MSOS.
So MSOS is the ETF of U.S. Cannabis, and I think that the probability that cannabis as a class of let's just call it a vice is smaller in the future than in the past is virtually nil. And I have an interest in the multi-state operators, specifically in limited license states, because I don't know how to handicap whether or not a brand is possible in that industry. I'm not very interested in the growing aspect of marijuana because I've just seen too many. I used to bank food companies, mm-hmm. and there's just too much of a risk of commoditization to me. But the distribution licenses, I could see a scenario where they remain on a state level, regardless of whether or not I could see a scenario where they remain valuable on a state level, regardless of whether or not interstate commerce is mandated. And the reason that I say that is if you look at a state like, Florida or Colorado, and you look at how the liquor is distributed in that state, there are very specific rules that govern within state distribution of alcohol, despite the fact that there has to be national wide competition. Mm-hmm. So the distribution licenses, I think, have a reasonably decent probability of accruing value over time.
And how far along are the companies at securing some of these?
It's an evolving market. So I think if you look at some of the companies, they're further along than others. They have different strategies, right? Like True Leave is one that I'm moderately familiar with. In Florida, they have like a real hub strategy, which reminds me a lot of actually Delta is what it reminds me a lot of, the Atlanta hub. And then there's Green Thumb, which has a strong presence in Illinois. In Illinois, Florida is not limited license, to my knowledge, but that could be wrong. So do your own due diligence. Illinois, I know, is limited license, and so Green Thumb has got a really good. I like the way that they talk about capital allocation. They are more all in on brands than maybe I am. I'm a little more skeptical on the ability for companies to create brands. I have smoked pot since college, so I've never cared which pot I've gotten. Mm-hmm. So I do kind of wonder about that. Though the edible products, edibles are very, the experience is not consistent. So I do think a brand in edibles could matter a lot. Mm-hmm. It's just forecasting which brand I find to be very, very difficult. So again, I'd rather sort of be the people that are just the arms dealers. And I think people will have a relationship with the retailer for a long, long time. And I think that these retail experiences are much, much better than people may appreciate. So it's kind of where I'm looking. MSOS is what I was looking at because they all trade in a somewhat correlated fashion, and that's the ETF.
And do you know the difference between MJ and MSOS?
I do not. MSOS is the one that I had top of mind.
Got it. Okay. Because I know, so I think I know MJ used to be kind of like the bigger ETF, but MSOS has come out more recently, so it started trading. It looks like in 2020. MJ, I'm just going to pull up, has been trading for since like 2016, 2018. But they have slightly different holdings, so two different kind of ways to express it.
Not the kind of chart you're looking for over the long term, but it's interesting. It's like patterns of euphoria and depression, it feels like to me. A skeptic would say that's because no one knows what the economics are going to be. So I think that's a fair argument. But I also think that there's these areas of change where being right can generate outsized returns.
Yeah. So I think, I don't know if you were kind of like looking at this market in 2018, 2007, 2018, but there was just like a lot of hype around the sector. A lot of companies went public. And then the sector kind of like deflated. And then with kind of this wave of legalization and acceptance and just, people just basically believing that pot is going to become mainstream, similar to kind of on the same level as alcohol. You had this kind of rally into Biden's election. And now you kind of have a pullback. So,
it's interesting. They say all gaps fill, right? There's a couple more gaps lower to fill before that, right down at between 10 and 12, it looks like they gapped up, and 12 and 13. So
if I were looking at this from just a technical perspective, this is actually a really good level to buy this stock, because this was a really strong gap, kind of like it consolidated here, created this gap. And so this gap would serve as kind of a support area for me. And so if I were looking at the space fundamentally, I would actually buy the ETF here, and my stop would be around here. This would be a level kind of like where it pushed against here and then came down. So this was resistance. Now it's support. And so
would you look at that breakout as a bull flag breakout, or is that being a little bit too loose? The breakout from back here in November?
So you're
January, right?
Yeah. So you're talking about kind of like here?
No, go back. Let's look at yeah. So okay, so right there, right? So that bottom, would you consider that like the beginning of a bull flag? And then you had this consolidation, and then it broke out up.
Yeah. So if I started like drawing some lines here, so this is sort of like a double bottom here. It's around the same thing, and then you have and then you have kind of like one consolidation here. Then you have this flag, and so here, ultimately, what this can turn out to be is just a big, massive consolidation, which is a flag here. That it sort of breaks out from, but that's that's the future hasn't been written yet. So that's kind of like, I would say this is still a bullish pattern, but this is testing its support here. And if I had a fundamental view of kind of like, hey, these stocks have a lot of revenue potential to the upside in the future, this would actually be a good place to start nibbling away.
Well, there you have it.
There you have it, Marion.
None of this is financial advice.
Don't do anything we're telling you to.
Yeah. But I do think, like, I feel badly. You talk about the podcast. I think I was part of the hype cycle there in March or whatever. But, I really do think, look, when you look at the penetration of painkillers in America, and you look at the amount that some people drink, and, I said I smoke pot. I don't. I have gone through periods where I smoke too much, but like it's not that habitual for me. Mm-hmm. But booze is that's what keeps me up at night. When I look at people that have like really ruined their life, I think a lot more have done it from booze than pot. And I think that a lot of our societal historical biases are from narratives that were sold in large part because of, for lack of a better term, I think a lot of it was racist. And I think some of that had to do with the fact that minorities couldn't afford alcohol because alcohol was priced where it was. Maybe my understanding of those facts is wrong, but I just don't think that you're going to keep marijuana down for very much longer.
Yeah, no, the war on drugs starting in the 70s and 80s when it was kind of a big problem in the African American community, and then drugs being a problem in rural America, kind of in more white parts of America later on, and then the war on drugs sort of shifts and stops being a war. Then there's definitely tinges that are racist to it. So. Um, Do you follow any of the other psychedelic, like mushroom companies or any of
I
those?
don't. That's like a little bit too far out there for me. I think everybody's got to have a line, but I've
Yeah,
talked to people that have told me that I should open up my mind to it a little bit. I don't know. Maybe I need to do some psychedelics to open my mind. Who knows?
yeah. I just started reading a book called "How to Change Your Mind," and it's about psychedelics and
I've
the
talked to a couple of people that have said that it gave them an experience that helped them for the better. But nobody will say that out loud because it's not exactly professionally beneficial.
yeah, and I think that thinking is shifting pretty rapidly, and I think this kind of like don't do drugs and the war on drugs and what were the slogans like in the like dare and all the kind of like programs that the government instituted.
Yeah.
All that communication was from the top, from the top down, and it was kind of like a couple of people deciding what's bad and what's good. And now that communication is obviously much more bottom up, you just have a lot more personal experience that's speaking through and kind of like sharing like what's actually bad and good, and how things are different.
Yeah, and I mean, I don't, if somebody's listening, I'm not trying to get people to do drugs. I just think it's a realistic. I think that people that invest in alcohol companies, for instance, really um, don't have the standing to talk down about marijuana or ESG, because when you really look at like who uses alcohol, it's a superpower law user base, and there's a lot of sorrow in the world created from booze. And I don't see it's a distinction without a difference in my opinion. And if there is a difference, I think pot's a lot less dangerous to society and to the person.
Yeah, absolutely. I'd agree with that. So, going to shifting away from pot.
We'll
Let's
go
say,
to curate. We'll talk about dealing things to old women. QRTEA.
cool. So, tell us. I'll just pull up the snapshot here. Tell us about Curate.
Well, anyone that listens to any of my podcasts can't get away from this idea. It's like my favorite company in the world. It's QVC and Home Shopping Network, plus Zulily and some Cornerstone brands. So Ballard Designs, and there's a couple of Frontgate, and then one or two more that I can't remember. But the interesting thing about this business is if you read expert interviews, and I've talked to some customers, I went on Facebook and I was like pinging old women, asking them what they thought about Curate. It was a little weird, I think. Well, actually, I asked them about QVC, not Curate. But it's fascinating to me how the consumer interacts with the platform, and the capital structure arguably has way too much debt on it. My view is that the debt doesn't have covenants, and the tenor of the maturities is underappreciated. So, can you? Yeah, there you go. If you could pull it up, that'd be great. So anyway, I think that people look at it and they say, look, we don't want anything that has to do with selling anything linear, like selling goods over the television, especially over linear TV. And then if you put a bunch of leverage on it, that's terrifying.
Mm-hmm.
I happen to think that the platform is doing a good job transitioning to the future. I think it would be nice from an investor relations standpoint if they had the data to prove to people that they were pivoting. They don't have that level of granularity into how many minutes people are watching on Roku or whatever, because I think Roku owns that data. But the underlying core business, I hate to say that COVID was good for them, but it came out of COVID quite a bit stronger than I think it went in. And if that's the case, it's trading today at 4.2 billion. I think it should generate somewhere between, I don't know, I've always said 5 to 750 million of sustainable free cash flow to equity. I think that's a little conservative, but that's not a huge free cash flow multiple on a business that arguably can generate $1 billion of free cash flow and has really good.
Is this number, like, is there something one time here? Because here it's showing 2 billion of of operating cash flow over the last 12 months.
Yeah, it's been huge. The thing is, the pandemic, everybody was locked in, right? So Q2 20 was way outsized, right? That was crazy. But people, the super fans love Curate, and they were locked inside for a little while, and that created the catalyst for really impressive business results. If you look back over like a 10-year history, the free cash flow from this entity pretty much stays between 800 million and $1 billion. And, it's sort of like clockwork. That's famous last words, right? And you don't get paid for driving out the rearview mirror, but it's a really, really interesting business to me to look at.
And I'm only showing kind of like 4 years worth of data, I guess, because it was a different entity before.
Well, what happened was they acquired HSN, and that changed some stuff.
Oh, got it. Okay, so we don't have looks like the price, but we have the financials here. So this is the free cash flow, at least LTM, that you're talking about here.
Yeah,
which is pretty steady here.
Yeah, it's wild. I think if you want to get like nerdy about it and try to sell the story, you say, oh, it's a subscription-like business trading at 4 times free cash flow. I think that's playing fast and loose with a fair amount of terms, but I also think it sort of conveys a message that's not totally wrong.
Yeah. And so when I think of QVC and I think of kind of TV shopping, obviously my mind goes to like, hey, this is going to disappear in X number of years. And everyone's like, what's the bull case? How's this company transitioning to a new world?
Well, when I think of QVC, sir, I think of quality, value, and convenience. But I acknowledge your concern and think it's not crazy. Look, I think that the investor community would love for them to be on TikTok. Their average consumer is somewhere between 55 and 60 years old. She isn't ready to transition to the internet. It's not a platform where kids are selling Pokemon cards or whatever. And, could they do a better job at maybe leaning into the future now and showing people we can become a business that serves a younger demo? Yeah, I would love for that to happen. But if that happens, I'm going to have a 10-bagger on my hands. Forget about some decent return. In general, the way that they have signed deals with Roku is they pay commissions to the platforms, right? So their channel being on platforms tends to be additive to whatever distribution platform they're on. Mm-hmm. So there's incentives for the platforms to not only have them on, but also to give them decent placement. And you're starting to see them, have better placement. I think they could do a lot of work with their hosts on how good their hosts are at social media. There's a lot of room for improvement, but at the end of the day, you're trading at 5 to 6 times free cash flow. The NFL rights are doing really well. I don't see the bundle going anywhere in the next 3 to 5 years, and a lot of your cash is coming back to you without a really good management team and without really good capital allocation. I wouldn't be at all interested in this security, but I think that the capital allocation story makes it very compelling.
So basically, like, if we take the central view of like, hey, TV isn't growing, but they have this engaged core audience. They know their business, they know the customer, they're generating a ton of cash flow, and so there's a lot of downside protection because of that valuation, and then there's a lot of upside optionality if they can figure out all these other kind of new and changing channels to target a wider audience.
Yeah, I think that's right. And I would put one finer point on, they're generating a lot of cash flow and they understand to get it back to shareholders.
Yeah.
And they've pivoted from a buyback strategy to last year they started paying cash dividends. And I think that's a big pivot. And, whether or not they continue doing it, I don't know. But what it at least signals to me is that they're open to doing it. So unlike Bed Bath and Beyond, I don't think that you have a management team that's going to sit there and just buy back shares, into the ground, right? I think that Greg Maffei and company are smart enough to understand that cash can go a long way too. Cash returns to minority shareholders.
Yeah. And so this is the interest expense thing that you're saying on the bear case is what some investors are worried about. Looks like they issued some more debt last year, and it's running at about a 450 net interest expense, which is more than covered by its cash flow now. But if it this is kind of like pressing up. If cash flow were to fall below this level, that would be kind of the bear case issue.
Yeah, and then you can obviously, with this much leverage on a company, if things start to unravel and then all of a sudden you can't roll the debt, you can get into some hairy situations. I mean, I would tell people that they should really, really try to understand what they own. I think the reason that the debt market is comfortable issuing the kind of debt that it has is the consumer behavior is incredibly reliable here. Mm-hmm. So, that's something that I can understand why people would say, I don't want anything to do with a 3.6 times levered, retailer tied to the bundle. But I also happen to think that's where the opportunity is.
Cool. Awesome. What's another idea you have?
What did I send you? I sent you that.
You mentioned Google as your.
I think Google's really interesting, mostly because we live in a world where the market's so efficient, right? And I was looking at my account, and my last purchase of Google was in October, and I noticed that it's up almost 80%. And I just kind of think that this is one of those interesting examples of, boy, even something that's really well covered and really well known can remain underappreciated. And somebody asked me, well, why do you own Curate when you could just own Google? And going back to the earlier conversation that we had, I think that out of the gate, you're going to get, somewhere, well, I'm not going to say you're going to get, I'm going to say that the market is potentially offering you a mid double digit return to common equity in Curate, where in Google, maybe you've got, I don't know, somewhere between 4 to 5% core free cash flow yield. Mm. I happen to think that, to grow from 4 to 5% into 20 at cost, or like on your cost basis, requires a level of growth that I am very rarely comfortable underwriting. Google is one of those assets that I think that I'm comfortable underwriting it there, and I'm comfortable with the growth path. I'm comfortable with the terminal value of the entity. But if I have, so do free cash flow to market cap of Curate. Yeah, there you go. So you can see there's a gap.
Different profiles, like you said.
Yeah, and like in my world, the odds offered matters. And I think that where that level of thinking, or that line of thinking can really, really screw me is I grew up going to the horse track, and there are certain horses that are just not worth betting on, no matter how good the odds are. Mm-hmm. So I need to be really, really dogmatic about making sure not to bet on the lame horses. Mm-hmm. But there are also a lot of favorites that are bad bets because of the odds offered. and I'm just trying to do my best to place bets accordingly.
And
And I own both these, right? So I think one is a favorite that is worth betting on, and I think one is an underappreciated middle of the level, middle of the pack horse that's got a reasonably good jockey and could win the race.
and, and that's the kind of that's the goal of portfolio construction, is to have stocks that aren't the same, is to have stocks that are different, that could work well together, but aren't necessarily the same kind of profile stock. That over the long term, those stocks kind of work the best with the ideal risk profile, instead of kind of having 10 Googles in a portfolio or 10 curates.
Yeah, I think that's right. I think that one of the issues that I toy around with is, at what point are you diversifying the portfolio?
Mm-hmm.
And I don't have a great answer to that, but I know that I'm comfortable owning both of these, and I'm have a fairly high degree of confidence that the portfolio is overall better with these two securities in it than it would be with one or the other.
So, everyone listening here knows Google.
Look at that thing bounce off a rock, or it's like off of a road, right? A golf ball. It's crazy.
So 10, I like that's a cool analogy. Golf ball off of a road. The 10-year kegger, right? It's up 10x over 10 years, or this a little more, is 26% per year over 10 years, which is pretty incredible and very consistent. So what makes this company, what makes this stock exciting for you? Search is one. What are the other businesses that the company is in that you're excited about?
Well, the stuff that I understand fundamentally is like search, YouTube, like core internet and mobile search, right? Then YouTube, and then cloud. That's sort of like what I can get my head around and understand. I think I have a reasonably decent understanding of the culture there. I was fortunate enough to be invited out by my buddy Rishi, and I got to talk to some people there that made me understand a little bit better what I used to perceive as like wasteful spending.
Mm-hmm.
I think is much closer to cultural development. Now, this could be a late cycle talk that I'm saying, but I do believe that there's real merit to that thought. And we'll see. I think it's a very ambitious company. I think it's got a very long growth rate in front of it. I think it's got very, very high returns on capital. And when they started their buyback program and switched CEOs to somebody that I thought was less of a sort of founder type, I mean, I really bought it in 2018. And then I've been buying more, and I was really happy to see the CEO change. And I think it's a more focused organization on minority shareholders than maybe it used to be.
Yeah, didn't their CFO come from Wall Street?
Yes, I believe that's true.
Right, and people kind of got a little bit. It was around 2018, I believe, and people got excited about the allocation of the capital, and that it's not going to be all on moonshots, and it's going to be a little bit more thoughtful and rigorous in terms of how capital is allocated.
Yeah, I think that's right. And I think that makes sense for a company that's hitting that level of maturity. That said, I mean, if they were to stop spending on moonshots completely, that would worry me a little bit, because I do think that the moonshot idea in that entity, I think that there's qualitative aspects to that line of thinking that will protect it in the future. But reining it in made a lot of sense to me.
Cool. And so it's a $2 trillion company.
Yes, this makes me nervous.
Yeah.
This you asked me, like, part of what I think my one of my diseases has been in the past is I look at some of these valuations and I ask myself, well, how the heck are you going to grow off of that base?
Yeah.
That's a problem.
Yeah.
Some of these global companies can, though, I think, right? But there is a natural limit, I think.
Well, they can't grow at so Google here has been growing revenue at, obviously this is a little bit inflated for COVID, stayed home, but So it looks like they've been growing at sort of like 20% before this big bump. If we look at the estimates, let's see what people are expecting to grow. People are expecting 37% this year, and then sort of like mid double digits the next 2 years.
Yeah.
But this is really kind of like internet growth, right? It's sort of like, is the internet going to continue to grow globally? And like Google is just Google doesn't have to do anything for it to grow; it just has to be part of the internet. And then there are other things where it could gain market share from, like in cloud and compute, and YouTube obviously is just such an important format, and maybe some of the headwinds that Curate's facing, YouTube's actually benefiting from.
Yeah, Curate would like to tell you that people can go to YouTube to watch their programming, but I've seen how many people do live view on YouTube, and I'm here to tell you that the messaging on that is disconnected from the reality. They only have maybe 20 viewers at any given time.
Yeah,
it seems.
That's because all the women are chatting with you and you're messaging them.
There's some of that's true. That's how I source some of the women that I tried to talk to.
Man, I would love to be part of that chat and to see the woman's kind of a reaction as you reach out to them.
I would have liked to have a camera on the wall too. Like, who is this weirdo and why does he want to talk to me?
This is Bill from Florida. Nice to meet you.
I did that at a Ralph Lauren store in Chicago once. I walked in and I was like, hey, how's business? Just curious. And the woman looked at me and she goes, are you from corporate? I was like, no, I'm not from corporate. I'm just curious. And she's like, well, I don't come into your job and ask you how your work's going. I said, okay, that's all I need to know. If you were less defensive, I think that you didn't, you were a little happier with the outcome.
Is this Undercover Boss?
Yeah, that's right. No, I'm just a weird guy.
Just doing my channel checks, ma'am.
That's right. That's exactly right. I was curious.
Cool. Awesome. Well, all really good ideas. I think there was some other things that emailed me, but we're sort of running up on time. We have unlike your show where you go kind of.
Yeah, you got a time limit here.
We have a time limit because, we usually do an hour and people tend to complain when we go over. So we'll adhere to that. Two things before I let you go. So, you mentioned Business Brew before. Definitely suggest that everyone subscribe to it. It's an unbelievable show with really high caliber guests. The conversations really dive into a bunch of topics, investing, but life, psychology, and so definitely recommend that you subscribe to it. Where is it on Apple Podcasts, or where can people find you?
Yeah, all your favorite podcast players. We're on them all, but Apple and Spotify. And if you would not mind leaving a rating, that would be greatly appreciated.
That's awesome. And I don't need to plug in the sponsor because hopefully everyone who's listening to this is using Koyfin. And then last thing is I ask people pretty simple question about kind of their favorite show that they're watching to recommend to listeners. Anything that you recommend in terms of either show or movie that you've recently watched.
Yeah, man.
Could be after you smoked or before you smoked.
No. You can watch this one sober. Class Action Park on HBO Max is like a very, very cool documentary. I interviewed the director of it on my show. Yeah, and it was super fun.
Oh man, I lived not too far away from there in Wayne, New Jersey.
Yeah,
and I remember going to Action Park and going on the Alpine slide.
Yeah, man, check it out. Seth Porges is the guy's name. I just dropped it on Monday, and it was a really fun conversation.
That's amazing. I need to check that out.
Yeah.
Awesome. Well, Bill, thanks so much for being on. This has been really enjoyed speaking with you, getting these ideas. And looking forward to sponsoring the rest of the Business Brew season.
Thank you very much, and have a good one.
Thanks, you too.